Welcome to Morris Money, where we give you stock tips in under 5 minutes. I'm your host, Morris Willie. Today, we're talking about the fair value of liquidity services, LQDT. This is based off a Simply Wall Street article, so we're going off their metrics for this video. Today, we'll do a simple run-through of a valuation method used to estimate the attractiveness of liquidity services as an investment opportunity by taking the forecasted future cash flows of the company and discounting them back to today's values. Our analysis will employ the discounted cash flow model. It may sound complicated, but it's actually quite simple. Remember, though, that there are many ways to estimate a company's value, and discounted cash flow is just one of those methods. We use what is known as a two-stage model, which simply means we have two different periods of growth rates for the company's cash flows. Generally, the first stage is higher growth and the second stage is lower growth phase. To begin with, we have to get estimates of the next 10 years of cash flow. Seeing as there's no analyst estimates of free cash flow available for us, we have to extrapolate the previous free cash flow from the company's last reported value. We assume companies with shrinking free cash flow will slow their rate of shrinkage, and that companies with growing free cash flow will see their growth rate slow over this period. We do this to reflect that growth trends to slow more in the early years than in the later years. A discounted cash flow is all about the idea that a dollar in the future is less valuable than a dollar today, and so the sum of these future cash flows is then discounted to today's value. After calculating the present value of future cash in the initial 10-year period, we need to calculate the terminal value, which accounts for all future cash flows beyond the first stage. For a number of reasons, a very conservative growth rate is used that cannot exceed that of a country's GDP growth. In this case, we have used the 5-year average of the 10-year government bond yield, 1.9%, to estimate future growth. In the same way as with the 10-year growth period, we discount future cash flow to today's value using a cost of equity of 6.4%. The total value or equity is the sum of the present value of the future cash flows, which in this case is $561 million. In the final step, we divide the equity value by the number of shares outstanding. Relative to the current share price of $13.64, the company appears about fair value at a 15% discount to where the stock currently trades at, with it giving an estimated fair value of around $15.77. Valuations are imprecise instruments, though. Rather like a telescope, move a few directions and end up in a different galaxy. Do keep this in mind, pretty much meaning, while yes, these price targets help with figuring out if an investment is good or not, it's also great to look at a couple different price targets, a couple different fair values to see what the company could be worth in your eyes, because they have a fair value of $15.77, and on majority of websites, there's only one price target for LQDT, and that's around $26, so that's a major difference in upside. But let me know what you think about the company. What do you think about this fair value, and do you have any potential price targets for the stock? Let me know below. Please don't take this video as financial advice, and thank you for watching Morris Money.